Ricketts.
Thank you very much, and thank you to all of our witnesses for being here today. In Nebraska, our banking system is built around regional and community banks and credit unions, not big banks. And they underwrite equipment purchases for farmers, extend working capital to small manufacturers and Main Street retailers. For many Nebraska families, they're the institution that helps them get a mortgage or a home construction loan or refinancing. And these institutions know their borrowers. They're personally connected to them and have a relationship-based model that continues for the life of the loan. So escrow questions, hardship requests, refinancing conversations are all handled locally, not at some distant call center. And under the current risk-based capital framework applicable to non-advanced approaches banks, mortgage servicing assets are subject to a 25% aggregate cap in the calculation of core capital. The dollar-for-dollar capital charge above the 25% cap forces banks that maintain bigger mortgage operations to incur severe punitive charges or sell off MSAs, meaning that they could have to cut existing valuable customer service relationships or turn away new customers in their communities. Chairman Hill, how much weight should be given to the impact that capital rules may have on the ability of smaller insured institutions to compete or retain servicing?
Senator, I think it's a major factor, and as a result, it's something that the banking agencies have been looking very closely at. Vice Chair Bowman spoke a couple weeks ago and spoke very eloquently about the importance of banks being able to provide those functions with their customers, and so that's something that we plan to include as part of our capital proposals next month.
Great. Well, thank you very much. I appreciate that. And Vice Chair Bowman, thank you for your focus on the thoughtful regulatory tailoring and your engagement to revisit the Basel III endgame. You've consistently emphasized that capital standards should be strong, but also appropriately calibrated to the size and complexity of the institution. And I know you've talked about this a little bit already, but in the case of community banks, in the case of a community bank that is well capitalized under the community bank leverage ratio framework, can the MSA cap be further tailored in a way that remains fully consistent with safety and soundness?
I think once we have introduced the Basel proposal, we can certainly have a conversation about whether or not it achieves the desired goal, and we would be happy, I'm sure all three of us would be happy to engage in that conversation.
And help me out, how long do you think that before you get that proposal?
So we'll have it introduced before the end of March.
Right.
Ideally.
Great, thank you.
I don't want to get ahead of it. Our plan is to have it introduced.
End of March-ish is what I heard there.
Yeah,
okay.
thank you.
Raising the cap for MSA helps ensure that a more orderly and liquid MSA market for all participants and can bring more stability in the single family mortgage marketplace. And that's obviously one of the goals of our committee here is to be able to do that. So thank you, Chairman Bowman, Chairman Hill, and Comptroller Gold. I appreciate your engagement on this issue and look forward to continuing to work with you on your staff on this. Chairman Hill, the FDIC oversees the chartering and supervision of industrial loan companies. At the end of President Trump's first term, the FDIC finalized significant revisions to the ILC regulatory framework. Those reforms strengthened parent company oversight and enhanced reporting requirements. Chairman Hill, for banks that have been chartered under those new regulations, would you assess that those regulations have been serving their intended purpose and improving the safety and soundness of the ILC sector?
Thanks for the question, Senator. Historically, ILCs have generally been subject to higher supervisory standards than other IDIs, and they also have typically been required to enter into agreements with their parent companies that require the parents to serve as a source of strength. The 2020 rule codified some of those historical practices from the FDIC, and it's a mechanism to ensure that ILCs, which are not subject to consolidated supervision at the parent level, are still operating in a safe and sound manner.
All right. So, do you think that it's having the reforms are having their intended effect?
Yes.
Okay. Thank you very much, Chairman Hill. Thank you, Mr. Chairman. I yield back.